Well, welcome back to Finance Uncut. On today's episode, a 1929 style stock market crash. Jeremy Grantham and Harry Dent thinks that we're about to see a stock market crash like 1929. Now, guys, I've been told that YouTube have been throttling back these videos on my channel. So if you have subscribed and hit that notification bell and you haven't seen my videos pop up in your feed, can you just click the unsubscribe button and re-click it, or click that notification bell? And don't forget, if you do like this video, please hit that like button. I'll also put a link in the description below to this video that I did where David Hunter is calling for potentially an 80% stock market crash as well. So probably something similar to 1929. But in this video, I want to focus on both Harry Dent and also Jeremy Grantham and have a look at some interesting data. One thing's clear with this chart is this tells us that the health of the economy. So we've got GDP growth there in green, or GDP in green. And you can see the amount of debt that we've created to get that kind of GDP growth. It really is pathetic and shows how sick our economy is. Also showing us how sick the economy is we've got forward PEs rising, so severely overvalued at the same time that earnings are falling. Okay, so you'd think that the stock market would be falling, that the PEs would correlate to that, but no, there's no correlation. This is all central bank driven asset bubbles, and in particular the stock market. And Jeremy Grantham says that there's bubbles everywhere. And what does he have to say about that? Well, he was asked, so if we were already in a bubble, then where do things stand right now? And his answer was, bubbles are unbelievably easy to see. It's knowing when the bus will come that is trickier. You see it when the markets are on the front pages instead of the financial pages, when the news is full of stories of people getting cheated, when new coins are being created every month. The scale of these things is so much bigger than in 1929 or in 2000. And we had a big market crash in 2000. So that's Jeremy Grantham's warning about the stock market. And he's been warning about it for at least 6 months that I know of, that we are heading into an almighty crash. So when we look at this chart, the question we need to ask ourselves is, are we about to see an increase in volatility? And there's probably none better on the volatility side of things than Chris Cole. And Chris is definitely thinking that volatility is going to come back in the stock market. In fact, he talks about, if the central banks try to squash or stop volatility in the stock market, then ultimately you're going to get volatility somewhere else, whether that's in societal unrest or other areas. But if we do see that stock market crash, then we're going to see volatility spike in a big way. One thing's for sure is when we look at the junk bond market, and whether it's looking at real yields or nominal yields, it is clear that there's huge amounts of speculation in the market. When you've got junk yields that are now under the CPI. So you've got negative real rates on junk bonds. Houston, we have a problem. I can't see how people think that this is normal, that this is healthy, that if you're jumping into the market now that you're going to have tremendous gains. Yeah, a lot of people have made some wonderful gains from the March 2020 lows, but are we sucking new people into the market now? Which is just in my opinion, it's the absolute worst time to be jumping in. I don't know. Am I crazy? Are we crazy to think that central banks aren't going to do anything else but pump liquidity into the system, which ultimately seems to go into the stock market? Not directly, although we know that the Bank of Japan buys the Nikkei, the ETF over there, so they actually do pump up the stock market directly. And that might be the next thing that we see in America and right across the world. I don't know. All I know is that we have got financial markets that are unhinged. And they're unhinged with bucket loads of debt. And I keep going on about this, whether it's government debt, corporate debt, household debt. We've got over 30% of small caps are zombie companies. We've got retail investors pouring in. Stan Druckenmiller recently just said that this is the first time in history that we've got such a big retail mania. Retail investors pouring into the stock market, and they're pouring in using options. They're pouring in using margin debt. And if this thing pops and this thing does go, and we start seeing margin calls, I talk about, or Mike Green talks about ETFs and the size of ETFs, and even Jack Bogle, the founder of Vanguard, said that once ETFs become more than 50% of the market, then it no longer serves its purpose and can actually be quite dangerous. And ETFs are huge. And I suggest you go and research, Google Mike Green ETFs or index fund, passive investing risks, and have a look at what he's got to say. Because it's great on the upside when everyone's buying, but look how it works when people are selling. And if margin calls are, kicked in, I mean, wow, the selling is going to be incredible. Something that I haven't seen since the .com bust. Ben Rickett, I've shared this tweet before. Total margin debt, .com bubble, 450 billion, Great Recession, 400 billion, now 850 billion. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis. Look, everyone's warning. All the smart people, all the smart money is warning. But I don't know. The people, the market can remain irrational longer than people can remain solvent. And JP Morgan warns hedge funds to expect intraday margin calls. There's a lot of risk, tremendous risk. And from an Australian perspective, so this chart, so we've had tremendous lockdowns recently. Sydney, our largest city in Australia, has been in lockdown for some time. We are now in lockdown in Queensland. Victoria forever in lockdown. And you can see that the lockdowns are now having an effect. But you can see in this chart that actually 2018 moving into 2019, our output was falling. And then we had the big drop in March, and then we had basically Fugazi, we had governments and central and the RBA just handing out, what does Johnny Bravo say? Chuck E. Cheese tokens. And so a lot of that output has been, in my opinion, artificial and not sustainable. And I think everything right now is not sustainable. Things can go on a lot longer, absolutely. But are they sustainable in the long run? Well, we're seeing a downturn in that output index. And Australia is going into recession again. There's no two ways about it. Absolutely no two ways about it. With the government policy, with the cough, well, we're going to see the economic consequences here in Australia. And look, even the deflationists, like I said, people like Henry Zerberg and Hoz and others, ultimately say that we're going to have stagflation, but they just think we're going to have deflation first. They think we're going to have this big deflationary bust. And this is a chart from Henrik. So he thinks that the commodity index is going to have a bust, that we're going to see a huge bust in credit markets, in the stock market, and actually in all markets. But then he thinks that we're going to go into a stagflation environment. Others actually say, yes, stagflation, very high inflation, and some say hyperinflation environment. So I guess everyone's kind of in agreement on the end game. It's just, what's the path in getting there? And this is an interesting chart. The Chinese yuan, the required deposit reserve ratio for banks. Now, we'll have a look at what Tavi has said about this. So Tavi said, I'm on the inflation side, but this chart concerns me. Yuan devaluation is one of the main deflationary risks today. I know you heard this over and over again, but something is indeed unraveling. Chinese banks and ADRs are in big trouble. The PBOC will be forced to act. And Daniel Lacaille, the Austrian economist, were thinking about a yuan devaluation as one of the main deflationary risks today. And these guys are on the inflation side of things. And we have a look at the US ISM PMI and Chinese ADRs. And you can see that graph right there. Now, once again, Tavi says, beware of this. The recent collapse in Chinese ADRs suggests significant deceleration in US PMI in the near future. Note, we had one of the strongest economic environments in history in the last 6 months. Now, growth seems to be mean reverting. And we potentially have got some issues with home sales as well. I don't know. Keep an eye on that. And the NASDAQ versus Chinese ADRs. Okay. So what does Tavi have to say about this? Another observation. It's hard to believe that a major downward move in Chinese equities wouldn't spill over on the rest of the world. Here is the same Chinese ADRs versus NASDAQ index. So this is something to keep an eye on. This is something to keep an eye on. Even the inflationists acknowledge the potential consequences of this. Now, everything that the central banks have been doing around the world has been on purpose. And seeing asset prices skyrocket has been on purpose. This is something that central banks intended to do. Now, they might disagree publicly now when asked questions such as wealth inequality. But I think this was back in 2011, maybe it was 2010, where Chairman Bernanke was asked about their policy, about monetary policy. He said, our tools involve, the tools we have involve affecting financial asset prices, and those are the tools of monetary policy. There are a number of different channels: mortgage rates, I mentioned other interest rates, corporate bond rates, but also the prices of various assets, like, for example, the prices of homes. To the extent that home prices begin to rise, consumers will feel wealthier, they'll feel more disposed to spend. If house prices are rising, people may be more willing to buy homes because they think that they'll, make a better return on that purchase. So house prices is one vehicle. Stock prices, many people own stocks directly or indirectly. The issue here is whether or not improving asset prices generally will make people more willing to spend. And this is the Keynesian economic system that we're in, folks. Crazy. In fact, Paul Krugman, after the dot-com bust, said, hey, create a housing bubble and, people will feel wealthier and people will spend. And that's exactly what the Fed did. And we had the 2008 bust. And since then, their economic model, forget about savings, the sound economics, Austrian economics, savings, and actually investing and building and creating products and services. No, forget that. Let's just create a whole bunch of debt. Let's just push up asset prices. And then, you know what? Maybe we feel rich. And so what we'll do is borrow some more to go and consume. Yep. Doesn't sound like an economic system that is sustainable. And they even admitted it. If you haven't seen the Power of the Fed frontline doco on PBS, I'll put a link in the description below, but they even admitted it on here that, yeah, look, wealth inequality is just one of the consequences of, the policy measures that we went with. And so they even admitted on here. So let's cut to a recent clip that Harry Dent did where he's talking about a stock market crash being imminent.
Okay, here we are on the last trading day, the 30th of July, and we're in a very interesting point. I've been warning that stocks could be peaking here. Stocks now, as we all know, have been overstimulated and overvalued for years, and they just continue more the same and more than ever. The real interesting item right now is the Treasury bonds. The Treasury bonds are always going to be overvalued too, and all bonds, because all this money coming in, that's where, the central banks buy bonds first, and then the profits from that trickle into buying stocks, and it always ends up in stocks more. But all of these financial assets are overvalued. But the Treasury bonds have gone mad, okay? We know right now the inflation rate has edged up to just over 5%. Jerome Powell said the other day, everybody thinks this is very temporary. He says, no, I don't see it being that temporary. And I don't either, but I do not see it lasting, of course, because I see a downturn coming. Now, but I looked the other day, even in long-term expectations of inflation, 1.5% to 2%. So a 10-year, even with that long-term outlook, forget the 5%, 1.5%, 2%, 1% above that minimum, they should be, we should be getting 2.5% or something, 2.5% on these Treasury bonds. And so at 1.2 to 1.3%, really, this is really a bubble in the Treasury bonds. So we have stocks highly overvalued and Treasury bonds highly overvalued. And normally, it wouldn't be as much for the bonds at this point in the cycle. So the real killer here is, of course, the crypto and Bitcoin. Bitcoin had a very strong run, as we know, to 65,000, and it has corrected, but it's the opposite for Bitcoin and crypto right now. It is extremely oversold, not overbought like stocks and Treasury bonds. It looks like it should rally significantly, and stocks and bonds both look ready for a downturn. Now, so the big questions here: is the stock downturn going to be a correction in, say, in August, and that's a natural correction month here, and then go up one more time in September before it peaks? And believe me, that's already pushing this way beyond what it should have been. By my best cycles, and they're very good by now, that this long-term bull market on the technology cycle should have peaked by early to mid last year, okay, kind of when it did with COVID, okay? So we're already pushing this way beyond, but this is unprecedented stimulus, okay? So is this a minor correction in stocks, and then we go one more time and then crash? Or if we do start to go down here soon in August, is it the beginning of this 50% plus crash? And that sounds crazy, but it's not crazy if you look at what I'm looking at. Every major bubble has done this. First crash, 40 to 50% down in 2 to 3 months. That is what you should expect if you understand bubbles and first crashes, okay? So are we on the cusp of that? And then, of course, the bonds would go even lower yields in that case. Or do we see the bonds being so extremely overvalued, such low yields, have to catch up back to real inflation, and that hits stocks and sends them down? So there's a couple triggers for stocks.
So Harry said he's expecting about a 50% crash over the next few months. And he says that bubble, has that big crash early on. And I remember last year he shared this chart for the ASX. So this is the Australian market. And he was expecting the market to bounce up to 5,800 and then down to 3,100 and possibly even down to 1,500. Now we have now hit all-time highs. So we've broken our all-time highs, and that's a long way to fall if Harry's right for our market. And at the same time, he shared this chart of the Dow Jones Industrial Average, saying that we're going to see the greatest crash since 1929 ahead. And so he went through some of these major bubbles, minor bubbles, and then said we're in a major bubble right now. And I agree that we're in a major bubble. He just sees that we're going to have an 80% plus market crash, stock market crash, like the 1929. Now, I think the central banks have shown their hand in what they'll do. I agree that if we had free markets and we were allowed to have price discovery, that we would see a market crash, something similar to this. But we don't have free markets. Capitalism is dead. We do not have creative destruction. We would rather have zombie economies and create zombie companies than allow a market crash of such significant size. But perhaps maybe with all the debt involved, that it just implodes. Maybe it just implodes. I don't know. What do you guys think? Do you guys think that the central bank, because really we're in a debt trap now. We're in a debt trap, and central banks, I don't know, do they keep doing what they're doing? Do they keep the pedal to the metal, or do they ease off? If inflation continues to get out of hand, I mean, they're creating the inflation, but if CPI continues to get out of hand, do they taper? Do they raise rates? Because if they do, then Harry Dent might end up being right. We might see an almighty crash. But if the markets fall 10, 20, 25%, won't central banks just revert course like they did in 2018 with the taper tantrum? I don't know. What do you guys think? Love to see your thoughts and opinions in the comments below. Don't forget to hit that like button. If you haven't yet subscribed, do so and hit that notification bell. Take care, everyone, and I'll see you again on another episode of Finance Uncut.